this mythology about how we have to pay the piper and the party's going to end and we have to pay for the party. I've been listening to that rhetoric for, I don't know, 11 years. I'm still waiting to pay the piper for the last big rally that took place from 2009 through 2016 before we had any sort of cyclical slowdown in stocks. So we've had periods of time where volatility reasserted itself. This year will be no different. It's not a bold call. Like I'm not going out on a limb saying that we're going to see a 10% drawdown at some point. It could start tomorrow, for all we know. That's not why I think most people who are watching this are investing, because they think the next 10% is definitely up. So I think if we just focus on the fact that there's a lot of stimulus and the intuitive trade is working, all of the things that you think will benefit from the reopening of the economy, those are the stocks that have taken the lead since the vaccine has come along. And now you've got participation in the FANGs too. It's really the best of %. So you've got broad participation. This is really a period of time where we acknowledge the fact markets are up a lot, but then we also acknowledge there's a reason why. You might get 40% S&P 500 earnings growth this year. You might get 6 or 7% GDP growth this year. What should markets be doing? Selling off?
Sarah, I guess the risk to that constructive view for the medium to long term is that maybe this time around, this next decade compared to last decade, inflation does pick up more meaningfully and rates do pick up more meaningfully, such that the valuation multiples get compressed. Is that a fear that people should have?
It's definitely the hot topic year to date, the question of whether inflation and the backup in yields that we're seeing are going to be an issue. And there is a risk that that is being pulled forward from what we originally thought was a 2023 issue to perhaps a 2022 issue. But some inflation for equities is positive. It means that the world is reopening and people are going back to business. And there are structural trends to consider when it comes to inflation, these headwinds such as negative demographics, higher productivity. And the key is also the slack in the labor market. As long as we aren't seeing a rise in wage inflation, we're not concerned about inflation in the short term.
There are other risks to consider, Josh. It's not just inflation and higher rates. How about higher taxes? Something President Biden has made clear he wants to see on corporations, on the wealthy, potentially on heirs. Not sure how much of it is possible to get done. There's that. There's COVID-19, which is still very much slowing economic activity and killing a lot of people in this country, and vaccines that are rolling out at a much slower pace than expected. There are risks here to this rally, which is trading at a record close. Josh, what do you make of them?
You need there to be risks. If there aren't any risks and people don't feel that there are any risks, we would be doing 10 SPACs a day right now. You would have biotechnology stocks becoming 30 or 40% of the S&P's market cap. You would have too much risk on behavior, and then you get into the Minsky moment stuff. I don't really feel that people are behaving that way in general. I think a lot of the wild risk-taking is in very specific areas like electric vehicles and some of the cloud software plays. And it's not really when you see Alphabet today, which I'm long, have this massive breakout, 6-7% move today. That's pent up. That stock hasn't really been able to do a lot for 6 months, but earnings estimates are going higher, and it's a reasonable multiple given its growth rate. I don't look at that and go bubble, right? The bubbles are in much more smaller, cordoned off areas, companies that aren't even in the S&P 500, Russell 3000 names. So I acknowledge that there are risks, and I hope some of those risks present themselves because I have stock to buy. So, I mean, as long as you have that mindset, that absolutely. So what's the next tape bomb? Sarah, I think you're dead right. The next tape bomb is going to be corporate tax or 1%er tax rhetoric. That's where it'll come from. That's the next thing that'll spook the market. And then I agree with what Kyle had to say about the rivalry between us and China. That'll heat up. Look at Chinese stocks right now going vertical. Look at the FXI. Look at KWeb, the Chinese internet names. They're going up 3-4% a day at this point. Is that China ratcheting up stimulus inside of their own stock market to make a point? I don't know. But I think taxes and China are going to be the two big risks. And then COVID, unfortunately, we've gotten very used to living with that. I don't think that's a new shock.
Shepard Smith here. Thanks for watching CNBC on YouTube.